First of all, because they're creditors rather than co-owners, bondholders have the right to receive their principal back at the end of the bond maturity, meaning that every bond has a certain time length during which the issuer is allowed to use the money that the bondholder originally invested, but at the end of this time period, the issuer has to pay the bondholder back the original amount of money. In addition, the creditor or bondholder is guaranteed a certain amount of interest for the investment. This interest is sometimes at a fixed rate of interest, sometimes at a variable rate of interest, but it's predetermined before the investor ever becomes a bondholder, before the investor ever buys a bond. So we could summarize that there are three main differences between stocks and bonds from the investor's point of view. The first is risk. All other things being equal, bonds carry less risk than stocks do. This is because as a bondholder, you are promised that your principal, the amount that you originally invested, will be repaid at the end of the bond's lifespan when the bond's maturity is reached. And there's no such guarantee if you're a stockholder. If you're a stockholder, you might be able to sell your stock, or you might be able to collect liquidated assets that equal the value of your original investment, but there's absolutely no guarantee on that. Similarly, bondholders are promised a certain interest payment over the duration of the bond, whereas stockholders may receive a dividend payment, but if the company performs poorly, might not ever receive a dividend. So if we're talking about a company that issues both stocks and bonds, then the bondholder will generally carry a lower level of risk than the stockholder will. There's a trade-off here, of course, though, and that's the return on the investment. Because stockholders are prepared to carry a higher level of risk, they expect a higher return, and historically seen, stockholders normally generate a higher level of return. This is because the return that a bondholder can generate is capped. No matter how well the company performs, a bondholder will never be paid more than the principal and the interest that was agreed upon in the beginning. In contrast to that, if a company performs exceptionally well, then there's really no limit to the amount of dividends that a stockholder can receive over time. So, as said, in terms of return, stockholders are generally in a better position than bondholders are. The third and final category concerns the voting rights. Stockholders, as has already been said, are generally allowed to vote at the annual general meeting unless their voting rights have been reduced in context of preferred shares. Bondholders are never allowed to vote. They're creditors, not owners, so they have no direct influence on the decision-making process of the company. Indirectly, if they're important bondholders, of course they might always have influence, but directly speaking or formally speaking, they do not have any voting rights in regards to the company policy. So let's take a look at the ways that Ebert and Griffin categorize bonds, and they list three different ways for us. First of all, bonds can be categorized based on who issued the bonds. Now, all bond issuers have in common that they are debtors. They take loans from the investors, but there's a few groups of debtors that typically issue bonds. First of all, there's federal governments. If a federal government, a Bundesregierung, issues a bond, then it's referred to as a government bond. Secondly, if bonds are issued at a local level, meaning by cities or by counties or municipalities, then we refer to these as municipal bonds. So if, for example, the city of Vienna were to issue a bond, then that would be called a municipal bond. Thirdly, we have corporate bonds. These are the bonds that are issued by companies. So these are the only private sector bonds in these three issuer groups. When companies issue bonds, they're referred to as corporate bonds. The second way that Ebert and Griffin categorized bonds is based on the level of anonymity, or flipped around, based on the amount of personal information that is known about bondholders. There are so-called registered bonds, and in this case, the company that issued the bonds has personal information on the investors that purchased the bonds. They usually have the name, the address, bank account information, etc. And so when it comes time to pay the interest, the amount of interest in question is merely transferred from the company's bank account to the bondholder's bank account, and that's the end of the story. Sometimes, though, very often actually, bondholders prefer their anonymity and purchase so-called bearer bonds. In the case of bearer bonds, the bond issuer, meaning the company or government, does not know who owns the bonds. There's no record of personal information. Now, this, on the one hand, protects the identity of the bondholder, but on the other hand makes it a little bit difficult to transfer the interest payments to the bondholder. And the way this is taken care of is that the bondholders themselves have to clip off certain coupons, either from the actual bond or from a document issued with the bond, and submit these coupons to their bank, which then forwards the coupons to the company and thereby receives the interest payment. The third way that Ebert and Griffin categorize bonds is based on collateral. Now, those of you that have had me in class already know that I don't like the translation security for Kreditsicherheit, meaning if a loan is taken and assets are provided to make sure that this loan can always be repaid, I prefer you to call them these assets collateral rather than securities, even though securities is the closer translation for the German Kreditsicherheit. The reason that I prefer that is demonstrated in this chapter. It's all too easy to confuse the term security with the type of security we've been talking about, with stocks and bonds. Collateral is a much clearer, unique term for Kreditsicherheit. Now, having said that, unfortunately, Ebert and Griffin divide bonds into two groups depending on whether or not collateral has been provided for them. First of all, there are secured bonds, which you can also call collateralized bonds if you want to make me happy. And in the case of secured bonds, the company has pledged certain assets. These assets are set aside and can only be used to repay the bondholders in case the company goes bankrupt, for example. So bonds that are secured or collateralized are generally fairly safe investment instruments. In contrast to collateralized or secured loans, debentures are bonds that have been issued by companies where no assets have specifically been set aside or pledged in order to cover the bondholder's investment in case the company goes bankrupt. Alright, so where do we buy and sell these securities? Generally, if we want to buy food, we'll go to a supermarket. If we want to buy a radio, we'll visit an electronics retailer. But where exactly does one go to buy stocks or bonds? The answer to this question is the securities exchange or stock exchange. A securities exchange is any organization that was founded in order to provide a location as well as clear rules that regulate the purchase and sale of securities. Please continue by watching the next video.